Welcome to this tutorial on stock market trading volume and dark pools. This is Dr. Barry Burns with TopDogTrading, and I've had a lot of people who recently have asked me why I don't talk more about volume when analyzing stock market charts, and so I'm going to share that with you today. So I do use volume in my analysis, but perhaps not as much as other people, and I'm going to give you the exact reason why right now. I've had people email me saying, no, the only leading indicator is volume. They say volume is a leading indicator. Okay, that sentence is completely wrong. Everything about that sentence is wrong. Number one, volume is not an indicator. Volume is just what it is. It's like price. Price isn't an indicator. It's not a mathematical calculation of anything. It's not a derivative of data. And neither is volume. Volume is just what it is, the number of shares in the stock market or lots or contracts in Forex or futures that are traded. So it's not an indicator, it is an actual fact. So it's not a derivative of anything, it's not a calculation. So first of all, to call volume an indicator is wrong. Number two, it is not leading. It is actually often lagging. So let's take a couple looks at that, and I'll explain to you why it's lagging, especially today. So in my trading, I'm buying cycle lows and shorting cycle highs in certain situations. You have to look at the whole landscape of the chart. So for example, if I wanted to buy a cycle low here, I would, buy literally right there, right in that bar. Now, where does our volume increase come? Our volume increase comes here, way up there. So if you were buying this and you're waiting for a surge of volume, which happens here, you wouldn't be getting in until here. And how far does the market go? Well, it goes there, and then it comes down and it breaks this low right here. Well, that means this is not a good time. It's not an optimal time to get into the market. If you wait for the volume to increase, you're actually getting in late. It is not a leading indicator. It's not a leading indication. It's not a leading anything. It's often late to the party. So I'm getting in before the big volume comes in. The big volume is great, but see, you would really have to suffer through this move against your position, against these lows. Psychologically, that can be very challenging to deal with. Now look over here. We had another obvious surge of volume right here with this bar. And what is that? Well, the market's actually coming down. That occurs on this red bar. So we've got this level of volume in here. It finally breaks out above that, but it breaks down or breaks out on a red bar while the market's coming down. And so that would almost make one think, well, maybe some big short selling is coming in. Nope, that's not at all what happened. In fact, it didn't move down much beyond that at all. And then the next obvious big surge in volume comes in on this bar. Again, late to the party, not early at the cycle low, not even at the breakout. And so it occurs about in the middle of the move. Hardly a leading indication. And so that's the second thing wrong with that statement is it is not leading at all. All right, moving to another section. Here's one way that I will use volume, and that is not for the beginning of moves. You would think that the market would start out with a big surge of volume to get momentum behind the move. And I've shown you that that's not quite the case. It usually occurs about in the middle or even a little bit later in an impulse move. Now here's one place where it does provide quite a bit of accuracy in many situations, and that's actually at the end of a move. So we get this exhaustion pattern, as it's typically called. Market comes down, and this impulse move down ends on exhaustion. Now, here we get a big move up, so some people might say, oh, look, see, it started a new move. Not really. Because often with these exhaustion patterns like this with big volume, they don't always go back up. Sometimes they'll just consolidate for a while. I've studied many of these charts and seen it over and over and over. Here's another example. There's a big surge of volume, and where does the market go? Really doesn't go anywhere, right? It just kind of goes sideways from there. And so again, here's another surge of volume. Where does it come in? It comes in the middle of the impulse move. Not at the low and not at the high. It comes in the middle. To me, that's late to the party. So here's an illustration of what I was talking about before for exhaustion patterns. So here's an exhaustion pattern. Market gaps down. We get a nice exhaustion pattern candlestick. Big volume coming in. Now, Again, some people would say, oh, that could be the beginning of a new up move. And I said, no, it can just go sideways. Here it does. It goes sideways for a while. And this is a daily chart. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, almost about 2 weeks, actually. A little more than 2 weeks, actually, because these are trading days. So it just consolidates for over 2 weeks, and then it goes down a little bit more. So just because you get an exhaustion pattern with high volume, that's not in and of itself a good reason to take a reversal trade, or in this case, to buy. So let's finish up talking about why this is happening, why this is true, why it's so counterintuitive, and why it's against traditional teaching. The reason is actually very simple. Volume as a leading indicator just isn't even accurate. It doesn't work. It's not reliable. And the reason is, hold on to your hats. There's a couple of reasons actually, but the primary reason, the big picture, is that the big institutions, the big players, the pension plans, everybody who's trading the huge money, they don't want to be tracked. And they know that if they come in with their huge orders, everybody in his parakeet looks down there and they can see that volume histogram, and they're going to use that to say, oh, the big boys are coming in. Guess what? They don't want you to know when they're coming in. So they do a couple of things. One thing they do is they come in through various means. In other words, they're not going to just buy, in this case, Disney. They're going to come in through various markets, through various exchanges, through different financial instruments. The other thing, and they might do it over time with accumulation. The other thing, though, that a lot of people are not aware of is dark pools. What are dark pools? Dark pools are non-exchange trading in the markets. So it's basically institutional investors who want to buy or sell huge, maybe 1 million shares of a stock. They don't want you to see that. So they actually will go to a dark pool, which is basically private exchanges or forums for trading stocks. So it's not a public stock exchange. So their volume that they're trading it, but it won't show up down here on your volume histogram. And by the way, they're a big deal. This is not something that's just occurring on a small scale. In fact, I did a little research on this, and it's Investopedia said that in 2014, non-exchange trading in the U.S. accounted for about 40% of all U.S. stock trades. 40%. So how can you rely on volume when 40% of the volume, and that, by the way, that 40% is not the little guy, that 40% are the big institutions, the pros, the whales, the smart money. The smart money's not showing up here, my friends. And that's why volume is very deceiving. Not only isn't it reliable, looking at your volume histogram can actually be very deceiving. If you found value in this video, please understand you have a moral obligation to pay it forward by clicking on the share button below and sharing it on social media. Also, if you're watching this on YouTube, please click the thumbs up icon below and leave a comment, because that really encourages me to give more free tutorials for you here. And I'm giving away one of my favorite trade strategies. I call it the rubber band trade. It has a very, very high win-loss ratio. I take this trade every single day, and you can learn it in about 26 short minutes. So get that video absolutely free by clicking in the image in the top right corner, or if you're on a mobile device, click on the little eye with a circle around it in the top right corner of this video. And if you're not watching this on YouTube, then there's probably a link below the video or an opt-in form on the side. Once you do that, I'll personally email the video to you with the rubber band trade strategy.